Welcome to the deep dive. Today we're really getting into the Q1 FY26 results for ICICI Bank, one of India's biggest financial names. We have an independent equity research report here, and our goal for you listening is to look past just the figures. We want to understand the story behind their performance, what's really driving things, what strategies are shifting. That's what we're digging into.
Exactly. And this report gives a really good overview. Yeah. What strikes you almost immediately is this change in their growth strategy. It's quite noticeable.
Change. Okay, so let's unpack that. The report itself has a BUY recommendation. It gives a review range, looks like RS 1,689 to 1,816. That suggests, what, maybe 14 to 23% upside from where it is now, around RS 1,477.
That's right. And what's really interesting, connecting those 2 points, is why they're recommending a buy alongside this strategic pivot. After, 17 straight quarters, that's more than 4 years of really strong loan growth, like 13% plus year on year. They're tapping the brakes a bit. They're saying, okay, priority now is protecting net interest margins, the NIMs, the core profitability from lending, protecting that over just expanding the balance sheet quickly, especially with interest rates potentially softening down the line.
Okay. So protecting margins over just sheer growth. Let's look at the numbers behind that. The loan book itself.
Right. The loan book grew 11% year on year and about 2% quarter on quarter. So it's at Rs 1.36 trillion now.
And where's that growth coming from? Is it broad-based or?
Well, domestic advances led the way, up 12% year on year. And it's really being driven by things like business banking and home loans. Those now make up 52% of their loan book, so over half.
And you mentioned a slowdown.
Yes. Interestingly, the unsecured retail segment, think personal loans, credit cards, they've deliberately slowed growth there by maybe 10-15% compared to last year. At the same time, deposits also grew nicely, 12% year on year, hitting Rs 1.61 trillion. And their CASA ratio, the cheap deposits, that actually improved to 41.2%.
So it sounds like controlled growth focusing on maybe safer areas.
Exactly. Quality over just quantity, it seems.
Which brings us to asset quality. How healthy is this loan book then with this new focus?
That's the crucial question, isn't it? The report shows the slippage ratio, that's new loans going bad, it did tick up slightly to 1.9% quarter on quarter. But, and this is important, the report notes this was mainly seasonal stuff in the agriculture portfolio. If you take agri out, the ratio is stable at 1.6%.
Okay, stable ex-agri. And the main bad loan numbers, GNPA and NPA.
Headline gross NPA stayed stable quarter on quarter at 1.8%. And the net NPAs, the ones they really expect losses on after provisions, flat at 0.4%. Very low.
And 0.4%, that's been pretty consistent, hasn't it?
Remarkably so. NPA has been under 1% for 16 consecutive quarters now. That's 4 years.
Wow. So what does that tell us?
Well, connecting the dots, you look at their provision coverage ratio, how much they've set aside. It's healthy, 76%. Plus, they have these significant contingency provisions, about Rs 131 billion, which is like 1% of their total loans. It's a strong safety net. The fact that NPA stays so low, even with minor bumps and slippages, really speaks to disciplined lending and good recovery processes. Real strength there, a solid foundation. Now, let's talk profitability. This is where that strategy shift should really show up, right? Protecting margins, net interest income, how did that look?
NII grew 11% year on year, came in at Rs 216 billion, so solid growth. However, there was some NIM compression, as expected perhaps, down 10 basis points year on year, so N is now 4.25%.
Only 10 basis points? Was that less than expected? It seems it was a bit better than some feared. And there's a nuance here from their earnings call. They mention part of that moderation was just a change in how they calculate it using actual months now, not days, supposedly to reduce volatility. Plus, they got a little boost, about 7 basis points, from some IT refund inflows, so underlying compression might be slightly different.
Okay, interesting details. What about income beyond interest? Fees, treasury.
That was a strong point, actually. Non-interest income grew a healthy 22% year on year. A big driver was a nearly 50% jump in dividend income and also some good treasury gains.
So putting it all together, the bottom line.
Net profit increased by a strong 16% year on year, and it was up 1% even from the previous quarter. Shows pretty robust core profitability despite the NIM pressure.
In costs. Always important for a bank.
Yeah, they managed costs well, too. The cost-to-income ratio actually improved. It came down to 38% from 40% a year ago. More efficient.
So the overall picture seems quite positive despite the caution on loan growth. What's the outlook then? What are they focusing on and what are the risks?
Well, management keeps stressing their focus on the retail franchise, continuing to improve asset quality and using those provision buffers smartly. The report also makes a good point about their subsidiaries, ICICI Life, ICICI Lombard. Their strong performance adds quite a bit of valuation support to the bank overall.
Makes sense. But it can't all be smooth sailing. Risks.
No, definitely risks to watch. The report flags a few key ones, potential for higher loan downgrades if the economy takes a hit. That's always there. Further NIM contraction is still possible despite the buffers they have. And, broader things like slower GDP growth or geopolitical tensions could impact asset quality down the line. Standard macro risks, really.
Right. So to sum up, ICICI Bank seems to be navigating this period by, well, taking a slightly more cautious path on growth. But the latest results still show strong core profits, really solid asset quality, and pretty strategic financial management overall.
Absolutely. And this deep dive into ICICI, it really highlights how these huge financial institutions try to balance that act, growth versus risk. Especially when the economic winds might be shifting, it does leave you with a thought, doesn't it? Is this pivot to cautious growth a sign of mature, stable strategy? Or is it more of a defensive move, bracing for potential headwinds? And maybe more broadly, what could this signal for the rest of the banking sector? Interesting times.